the world's strongest economy, did not grow on its own through a natural process as much as you might think. It did not happen through production alone, hard work alone, or material resources alone. Behind the curtain, there were pre-written financial moves, systems that distributed risk to others, and strategies that turned crises into advantage. The most important factor behind the American economy's rise to the top was not only growth, but also setting the financial rules of the game in its own favor. If you enjoy these critical moves and real stories behind the scenes of economic history, don't forget to subscribe to the channel. Your support helps new episodes get produced. Now let's go back to the very beginning of the story. The story begins with a young state, a country that had gained independence but had a weak treasury, high debt, and a disorganized money system. The newly established United States was politically free but financially fragile. The difference appeared here. The founding leadership realized very early that economic power comes not only from collecting taxes, but from building trust. The first major financial maneuver was not eliminating the debt, but restructuring the debt. The federal administration assumed the state debts and gathered them all under one roof. From the outside, this step looked risky, but inside it created a strong bond, because now creditors were tied not to individual states, but to the central government. Debt turned from a burden into a binding instrument. Government bonds began to be traded in the market. This was the first major practice where trust was priced. By lending to the government, people became partners in the system. During the same period, the idea of a national bank was put into action. The goal was not only to print money, it was to produce credit. Credit was the accelerator of growth. The bank financed trade, trade generated taxes, and taxes strengthened the state. The cycle was built deliberately. In addition, property and contract law were especially protected. For an investor, the most critical factor is security before return. The enforcement of contracts by the courts encouraged capital. While in Europe capital often depended on palace permission, here it depended on contract. This small difference attracted big money. So the first financial trick was this. Trust was pumped in before money was printed. Once trust was established, money found its own path. The second critical financial move of the young economy was that it did not think of money only as a metal, kept in a vault, but turned it into a tool that moves within the system. At that time, many countries had tightly tied their monetary systems to gold and silver. Although this was a simple confidence-building choice, it also slowed growth. America, however, discovered and adopted a more flexible credit structure early on. Banks were able to produce economic activity, not only equal to the reserves in their vaults, but equal to the credit they issued. This approach was criticized, considered risky, and in some periods even led to sharp collapses. But at the same time, it also accelerated growth, because the amount of money circulating in the market could adapt to the speed of trade. Merchants bought goods with debt, sold them, and reinvested again. The credit chain fed production. The critical point here was this. The system did not try to eliminate error completely. It was built on a wide enough field to absorb error. In the same years, land policy was also used like a financial instrument. The state distributed vast western lands, not only for settlement, but also as economic collateral. Owning land meant being able to access credit, because banks accepted land as collateral. Thus, property began to become fuel for the financial system. Land that stood frozen in the hands of aristocrats in Europe turned into a debt-producing asset in America. In addition, entrepreneurial culture was also protected legally. Those who failed were not completely pushed out of the system. Bankruptcy laws allowed trying again. This made risk not punished, but manageable. Risk takers increased, enterprise grew, and economic movement expanded. There was a structure that looked complex on the surface, but was consistent inside. Credit expansion plus collateralized property plus second chance law. This trio worked together in harmony. The driving force of the economy was not only hard work, but also financial leverage. The third critical move revealed itself in how crises were handled. When many countries experienced financial panic, they moved to shut down the system, close markets, and cut off money flow. America, however, used every major shock to its advantage to recalibrate the system. Throughout the 19th century, there were banking panics, credit contractions, and severe recessions. Banks failed, deposits were wiped out, markets froze. But after every collapse, the financial structure became a bit more centralized and a bit more rule-based. This repeating cycle eventually strengthened a new idea, the lender of last resort. In other words, a center that would provide liquidity to the market in times of crisis. Thus, the Federal Reserve System was born. This structure was not only a money-printing institution, but a balancing mechanism that kept credit channels open during panic. The message was clear: the system may fall, but it will not completely lock up. This confidence alone could calm markets. During the same period, the relationship between the state and large capital also changed. Railroads, heavy industry, and infrastructure projects were built by the private sector but often grew with public support. The state gave land, incentives, and contracts. Private companies built scale. Risk was distributed, profit expanded. Although this model looked like privilege from the outside, it created an accelerating effect inside. Because as infrastructure grew, the market grew. As the market grew, finance deepened. Another important step was the expansion of capital markets. Stock and bond markets were deepened. Companies were able to find funds directly from investors, not only through bank credit. Risk was divided into pieces. Even small investors were able to participate in large projects. This democratized finance but also moved the system to massive scale. The invisible financial move was this: crises were not suppressed, but institutionalized and controlled. Each panic was turned into the infrastructure of the next growth phase, accelerating expansion. So what was another major advantage that accelerated these processes? The most accurate answer would be that America turned its currency into not only a national tool, but a global one. To call a country's economy powerful, production capacity or trade volume alone will not give the correct answer. The real indicator of scale is how widely its currency is accepted in markets beyond its borders. By the mid-20th century, the United States was one of the few major economies that emerged from the wars without being destroyed. Industry was intact, production capacity was high, and gold reserves were large. This advantage became decisive. At the table where the international monetary order was rebuilt, with the Bretton Woods system, the dollar settled at the center of global trade. Many currencies were pegged to the dollar. The dollar itself was fixed to gold. This structure gave America a unique financial leverage, because as the world traded, demand for dollars increased. As demand increased, the U.S. was able to borrow at lower cost. This was a seemingly simple but deeply effective financial superiority. Even after the gold link was removed, the habit strength of the dollar continued. A large portion of energy trade began to be conducted in dollars. A significant share of global reserves was held in dollar terms. Thus, America's currency began to circulate far beyond its national borders. The practical result was this: when the U.S. borrowed, it could draw funds not only from its own market, but from the world's savings. This made it easier to manage budget deficits and provided additional financing during growth periods. In the same period, American financial markets were also turned into a deep and liquid safe haven for foreign capital. Legal protection, contract security, and transparent reporting standards attracted investors. Money goes not only to high returns but also to safe ground. The U.S. deliberately built this ground. The hidden financial strategy of the United States that few understood was this: being a strong economy alone is not enough. You must also make other people's money work inside your system. Another critical factor in the path toward a major economy was the ability to use crises, not as collapses but as opportunities for restructuring. There is a notable characteristic in the American economic structure. When the system makes a mistake, it does not completely collapse. Mechanisms are activated to recalibrate it. This reflex was not accidental, but the result of deliberate choices. Banking crises, stock market crashes, and recessions became turning points that triggered institutional regulations. After the panic of 1907, the need for a central bank became clear, and within a few years a more coordinated monetary authority was established. The Great Depression of 1929 showed how financial markets collapse when left without rules. After that, deposit insurance, market oversight, and securities regulations were put into effect. In other words, crises made the weak points of the system visible. Regulations patched those weaknesses. The financial intelligence behind this approach was this: instead of hiding the problem, recording it and binding it to rules. In addition, America developed one of the rare economic cultures that does not treat entrepreneurial failure as an economic crime. A company may fail, an investment may be lost, but pushing the entrepreneur out of the system was not considered right. This was perceived in the market as an attitude that encouraged risk-taking. Where there is risk, there is also bankruptcy. But in the same place, great innovations are born. For this reason, capital markets became increasingly deeper. Venture capital, private funds, and stock markets turned into channels that financed new ideas. Government contracts, defense spending, and infrastructure projects also gave scale to the private sector. A bridge was built between public spending and private enterprise. Thus, economic growth did not depend on a single engine. This structure, which appears volatile on the surface, actually survived thanks to its flexibility. The so-called financial trick here was not an accounting game. It was the creation of a system that tolerates error and adapts quickly. When the full picture from the beginning to today is viewed as a whole, it is not possible to speak of a single secret formula that explains America's economic power. There is no single trick. There is a chain of strategic choices that complement each other. Knowing how to use debt as a tool, managing liquidity through central bank power, turning law into a secure foundation for capital, placing the currency at the center of global trade, and transforming crises into opportunities for structural reform. When these elements work together, a resilient financial architecture emerges. The most striking aspect of this architecture is that while it appears complex on the surface, it is systematic in operation. There were rules, there were institutions, and most importantly, there were records. Money flows could be tracked, risk could be priced, and contracts could be enforced. For the global investor, the most valuable thing is not high return, but predictability. The U.S. economy attracted capital for a long time because it provided this predictability. At the same time, the real production base was supported through technology, defense, and infrastructure investments. When a connection is established between finance and production, growth becomes durable. Of course, mistakes, bubbles, and severe crises also occurred. However, after each shock, the system expanded its institutional capacity a little more. In the end, power comes not only from being able to print money, but from being able to build trust in money. That was exactly the distinguishing feature of the American economy from its founding onward, using financial instruments aggressively but within an institutional framework. To summarize the story, it would be correct to say this: great economies are built not only with rich resources, but with properly designed monetary and institutional systems, and the ability to implement them. In your opinion, what truly makes an economy strong? More money or stronger practices? Write your view in the comments. Different perspectives make these subjects more meaningful. If this series gave you a new perspective, don't forget to like the video and become part of the channel. We will meet in the next episode with a new economic story.